In October, we issued a report titled "The Treasury Bubble is Bursting." This was based in large part on data provided to us by the federal government. Specifically, they show us the progress of the $1.2 trillion repurchase program. This is a snapshot of the long bond repurchases. It shows us that as October was coming, the $300 billion that were allocated by the government to buy long bonds had been exhausted. In effect, the federal government had run out of money for this particular repurchase program. However, there were more than just long-term repurchases. The federal government also authorized the buying of mortgage-backed securities and agency bonds. In total, $1.2 trillion was allocated to these repurchase programs. And based on the government and the data that the government supplies to us, it's evident that the repurchase program has come full circle. Unless they add more to the pool of money that has already been allocated to do this, their ability to buy bonds and support Treasury prices has been exhausted. This program started in March. The Fed allocated $1.2 trillion into the market. Let's take a look at what happened since then. First of all, the stock market increased quite a bit. From that repurchase announcement till now, the market is up substantially. Normally, when the markets do well, investors do not flee to investments like treasuries because less risk is perceived in the market. That means demand typically is lower when the market is doing well, and demand is typically higher when the market is doing poorly. So in this particular environment, we would expect that demand levels would decline. In addition, since that March announcement, the value of the dollar has fallen by about 15%. If the value of the dollar declines, investments in low-yielding Treasury bonds become far less attractive to foreign investors. A 3% yield on a Treasury note coupled with a 15% decline in currency value presents quite a hefty loss when billions and billions of dollars are being invested. These are two very interesting points, and each of them suggest that the demand for Treasury bonds should actually be much lower than what we have seen recently. I am going to offer some supporting evidence here. The supporting evidence suggests that indeed the bubble in the Treasury market is over. If you have not already read our detailed report, please go to Stock Traders Daily and read "The Treasury Bubble is about to burst." It explains why we believe this will happen. The premise is simple. We believe the Fed is out of money. The $1.2 trillion has been exhausted. Now the markets are open to trade without the underlying support of the federal government. That means if indeed demand for Treasury bonds was inflated, that demand levels should start to come down into a more reasonable level. This chart is very revealing. This is a chart of the bid to cover ratios for the long-term Treasury bonds dating back to 2007. Once the problems started to happen in our market, the bid to covers started to go down. That told us that investors were less willing to hold on to Treasury bonds. They were nervous for a number of reasons, most of which surround the value of the dollar. And rightfully so. We've witnessed a severe decline in the value of the dollar. However, when this Treasury program came about, when the government started its $1.2 trillion buyback, things changed. And instead of declining, the bid to cover ratios began to increase, and they increased quite aggressively. This happened even though the value of the dollar was declining, and even though the stock market was increasing, each of which normally would suggest that the bid to cover ratios would not increase aggressively. Yet they did. They did because, in my opinion, the Treasury was supporting Treasury bonds. My opinion also suggests that they are out of money. And if they indeed are out of money, then the bid to cover ratios for those bonds should decline. Eventually, after that starts, the prices of those bonds should also decline. We have seen the first part of this start already. This chart provides evidence. In September, the bid to cover ratio for the long-term bond peaked. Since then, it has declined aggressively. Arguably, it is in the process of declining right now. A simple review of trend lines shows us that the trend line has been broken and that further declines in the bid to cover lie ahead. If that is true, then eventually the prices of long-term Treasury bonds will also decline. For more information, please go to StockTradersDaily.com and make sure you read the report. The Treasury Bubble is about to burst.